One sector to watch at the open this morning, it's the banks under pressure. Even after regulators swooped in to reassure depositors, the KBW Bank Index, worst week last week since March of 2020. Kailey Leinz back with us with more. Hey, Kailey.
Yeah, worst week since 2020 last week, John, and this week is not starting out on a better note, despite the fact that depositors of both Silicon Valley Bank and Signature Bank are going to be made whole. And the Fed has announced this new bank term lending facility that is going to lend to banks at extremely favorable rates. That is not helping the regional banks this morning. Clearly, there is still fear out there about this spreading elsewhere. Just take a look at the shares of First Republic, down 65% here at the opening bell. This is on top of a 33% loss last week. A week ago, this was $122 stock. This morning, it is trading at $28 a share. That is how brutal this wipeout has been, John. And it's elsewhere in the regional banks as well. PacWest, Western Alliance, Zions, they're all down substantially in the first few minutes of trading here. Western Alliance down 70% with about a minute and a half into the trading session. We will see if these losses hold throughout the day. And it's bleeding through to some of those larger banks as well. The conversation we were having on Friday is these are diversified financials. They don't have as much risk. They don't have as much concentrated exposure, so they were relatively more resilient, but that is not the case this morning. Really, all of the banks are lower. Right now, Citigroup, Bank of America, Wells Fargo, all down in the ballpark of between 4 and 5%. JP Morgan, the relative outperformer here, but still down the better part of 2% early in the session. And of course, we have seen the banks under pressure for some time now, John, but it is the regionals that have been lagging over the course of the last year. Again, the concern here being that they are more exposed to the Fed's rate hiking cycle, and it's raising questions this morning about how much further the Fed realistically can go when you are seeing this kind of pain in the regional banking sector, John.
Those names getting absolutely battered. Kailey Leinz, thanks for that. A lot of analysts weighing in on the situation. We spoke to Gerard Cassidy of RBC. He published this. He wrote the following: though we recognize we are not out of the woods, there is a light shining through that will lead us out. This sounds promising. We expect there will be opportunities over the near term to buy banks as the market realizes the actions announced yesterday will limit and prevent future bank runs. That last line. Can we go back to that board with all the banks on it and just look at that last line? Gerard Cassidy of RBC believes at some point this market will realize the actions announced yesterday will limit and prevent future bank runs. And we still look like this morning. First Republic down 65%, PacWest down 36%, Western Alliance down 74%. CFRA's Ken Leon has this to say this morning: the fallout of this idiosyncratic episode is higher perceived risk in the financial system and worries about contagion that we do not see ahead. The larger banks are likely to gain market share from smaller banks in the current environment. Ken, I'm pleased to say, joined us right now. Ken, can we just start with the market action this morning? You and I have got a lot to talk about, but what do you make of these moves in the early part of the session?
So there's investor worries really on the depositor side to see if there's going to be an exit out of some of the smaller mid-sized banks. Larger banks are fortress balance sheets. That's the deposit side. The other side is really what triggered this was really their debt investments in securities like mortgage-backed securities held to maturity. If we had any change from the Fed that say perhaps clean it up in 1 year, that becomes a risk at large for the industry. We don't see that, but that's what really unwinds in this kind of market, is trying to create confidence. I think the president did that for the general economy, but as we look at equities here, there's still all the stirrings as it relates to what is here. Now, what's different than 2008 is these are transparent assets. They're all in the 10K. And it's just a question of going through each of these banks. Obviously, the ones that had concentration in deposits got hurt quickly. First Republic today, especially with the Fed and JP Morgan coming in for $70 billion, but it hasn't helped. So obviously, the equity markets are very worried.